Hi, thank you very much for taking this course called How to Start Investing. My big promise to you for this course is that I will show you how to start investing is only 30 days without any prior finance knowledge and with as little as $5,000. Let me share with you a little bit about my story. I was first exposed to investing at the age of 13 when I read the book Rich Dad Poor Dad. By reading that book, I understood how important it is to invest and not just rely on the age-old mantra of go to school, get a good job, and retire with a good sum of savings. I therefore read multiple books, attended many seminars and trainings during my college days. And when I graduated and got my first job, I thought I knew it all, and I went out and bought a stock that tanked by 90%. However, refusing to accept failure, I then spent almost $6,000 on trainings and mentors, and sometimes some of it didn't work for me. However, I continued to read even more books, attended more seminars, sometimes up to 5 times a week, over a period of several years. And then finally, one day, 13 years after reading the book Rich Dad Poor Dad, that fine day, it finally made sense. It all made sense to me, finally. And then I applied that knowledge to make a return of about 50%. My entire account went up 50%. And one of the stocks that I bought, it doubled in just 7 months. And today, I manage my portfolio, which has reached well into the five figures. Because of these results, some good opportunities came by. For example, this one right here. This is a picture of me receiving an autographed book from Mary Buffett, who was the ex-daughter-in-law of Warren Buffett. And she learned from Warren Buffett for about 10 years or so as his daughter-in-law. So what will this course do for you? There are a few objectives that I had in mind when I created this course. Firstly, I want to simplify for you what investing is all about. When you start investing, it can be all too confusing with learning this and learning that and all kinds of jargons. But I want to simplify and explain exactly what this investing thing is about. Number two, I want to show you how you can have enough money to invest. When you're first starting out, not having enough money to invest can be a big problem. I faced the same problem, and I will show you how I overcame it. Number three, you will learn the secrets of how money works that not a lot of people know. Once you learn this, you can overcome the fear of investing. A lot of people are fearful of investing because of, say, for example, the 2008 financial crisis. But if you know how money works and why those crashes occur, you will not be afraid anymore. And lastly, I want to show you how you can set and achieve your goals when it comes to investing in spite of any limitations that you may have. For example, lack of time or not knowing how to read financial statements, etc. All these challenges can be overcome by finding a strategy that fits you and your unique individuality. So let's get started. The first step to investing is how to overcome your fear. Studies show that after the 2008 financial crisis, a lot of people, especially millennials, are afraid to invest. I faced this problem myself. During 2008, I was in college and I saw a lot of people around me getting affected by the crisis. Some of my friends lost their jobs, and so on. And to make things worse, as I just shared with you, when I made my first investment, I lost 90% of my money. However, I went out there and learned a lot of things that helped me overcome this fear. And in order to overcome this fear, we need to understand how money works. So let's look at this fictitious island of Moneyland, where there are three people, a fisherman, a baker, and a weaver. And the fisherman makes 10 fish, the baker makes 10 loaves of bread, and the weaver makes 5 robes for people to wear. You see, in the old days, people resorted to barter to get what you didn't have. So if the fisherman wanted some bread, he had to offer his fish to the baker and get the bread in return. But sometimes the problem would be that the baker may not want the fish. So we realized that we need to create this thing called money. So what this fictitious island of Moneyland does in our example is they create dollars to create paper money, and they put a price to each good. So a fish is $5, a loaf of bread is $3, and one robe is, say, $10, for example. So if you add these numbers up, there's a total of about $130 worth of goods that they are producing. Now, in order to make sure that they don't just create money out of nowhere, each $1 note is redeemable by 1 ounce of silver coin. And this is the monetary system that we had up until about 1970. Now, let's say, for example, they say, okay, we don't want this silver and all that trouble of converting and all that stuff. So let's just create paper money as and when we want. So what they do is they create $3 million worth of $1 bills, and now each of those three people could become a millionaire. Yippee! But the problem with that is, what good is all that money when the production of goods is still the same? The purpose of all those paper money is to buy goods with it. Creating more paper money and not creating more goods that money can buy is of no use. The only result that will have is that the prices of goods will rise. So before, let's say if you had $100 in savings, you could have bought a lot of fish and some bread and some robes with it. But now, as you see in the table here, since so much money has been created, the price of fish has gone up from $5 to $500. And therefore, $100 in savings now cannot buy you anything at all. You may have wondered, where does money come from? They say money doesn't grow on trees. It is created out of nothing on computer screens. The problem is you and I can't do that. That would be called counterfeiting. But the banks can create money out of nowhere. And that's why, as we see in this example, the prices of goods keep rising, and that's referred to as inflation. And that's why, if you and I save money in the bank, eventually over time, it will lose its value and it cannot buy as many goods. Now let's look at another scenario. Let's say that Moneyland creates all this money, but instead of just giving it away, let's say they lend it out at 5% interest. So now each of these people, the fisherman, the baker, and the weaver, they all have $1 million in the bank. Now what that can create is that the fisherman goes out, the fisherman and the baker, for example, they go out and they spend all this money to buy robes from the weaver. So initially, the weaver is doing awesome. He's seeing all this business come in, and his business is flourishing, and things are rosy and things are great. However, just because you have more money doesn't mean you're going to buy more bread and fish to eat, because there's only so much you can eat in a day. Therefore, when the time comes when the fisherman and the baker have to repay the $1 million at the 5% interest, they say, uh-oh, we don't have that money anymore. So now they are forced to sell their homes or sell their belongings in order to come up with the money to pay it back. And now, since they don't have all that money to spend, they cannot buy as much stuff from the weaver anymore. So his business is affected. This is what is referred to as the business cycle, and that is what causes stock market crashes, as we will see shortly in more detail. So we can explain student debt in the same way. Of course, it is a bit more complicated than this, but the simplest way to explain how student debt got so high is as follows. So let's say there's a student, there's a college, and initially, when money could not be created out of thin air, the student was able to earn about $5 an hour, and the college would charge about $1,000 a year in tuition. Now, we went off that gold standard, the convertibility, and we allowed people, or the banks specifically, to create money out of thin air. So now what could happen, and what has happened, or rather what has sort of happened, is that the students continue to earn $5 an hour, say for example, but now the college raises their tuition to $100,000 a year. So how are they going to afford? How are the students going to afford these $100,000? Now what the banker does is they create $100,000 out of thin air and they loan it out to the student as a student loan in order to pay for college. And that's the simplest way to explain how student debt got so high. Of course, it's a little bit more complicated than this, but this is highly simplified in order to make it easy to understand. So you may be wondering, well, which one is it? Is money being created or is debt being created? The answer is both. Money and debt are both created simultaneously. So prices rise, but also debt levels are also constantly rising. And that leads us to the Austrian theory of the business cycle, which says that if you create too much debt, it leads to bad investments. The money goes to people or maybe even companies who can't afford to pay it back. And when they cannot pay it back, the music stops, so to speak, and things come crashing down. Just like in our example, where it was time for the fisherman and the baker to pay the money back, and they couldn't pay it back, well, now they cannot buy as much stuff from the weaver anymore, and therefore the weaver's business is also affected. So, this can help us explain what causes stock market crashes. It's the exact same thing. It's too much debt. When banks lend out too much money and when it can't be paid back, things crash. An example would be in 2001, we had the dot com crash. And 2008, which we all remember all too well, was the housing crash. Now let's look at a layman example of this Mary's bar to understand exactly how these crashes occur. So here's an article that I once found on the internet that explains this concept pretty well. It says Mary is the proprietor of a bar in Dublin. She realizes that virtually all of her customers are unemployed alcoholics and, as such, can no longer afford to patronize her bar. She will go broke. To solve this problem, she comes up with a new marketing plan that allows her customers to drink now but pay later. She keeps track of the drinks consumed on a ledger, thereby granting the customers loans. This is key. Word gets around about Mary's drink now, pay later marketing strategy, and as a result, increasing numbers of customers flood into Mary's bar. Soon, she has the largest sales volume for any bar in Dublin. All is starting to look rosy, just like in our example of the fictitious island of Moneyland. Now I'm going to skip through some details to simplify things. A young and dynamic vice president at the local bank recognizes that these customer debts constitute valuable future assets and increases Mary's borrowing limit. To simplify things, what the bank does is they loan Mary a lot of money to keep this business going so that people can continue to buy from her even though they can't afford it. And then, once again, to simplify things, I'm going to skip through a lot of things. And one day, what happens is that a risk manager at the original local bank decides that the time has come to demand payment on the debts incurred by the drinkers at Mary's bar. He so informs Mary. So he goes to Mary and says, "Please give us our money back. Thank you." So Mary then demands payment from her alcoholic patrons. But being unemployed alcoholics, they cannot pay back their drinking debts. And since Mary cannot fulfill her loan obligations, she's forced into bankruptcy. She's now broke. The bar closes and 11 employees lose their jobs. Her wine supplier also claims bankruptcy, closing the doors on a family business that had endured for 3 generations. So, this is a good way to understand how, when you have a fiat monetary system, a system in which money can be created out of thin air and can be loaned out just by a few banks and not the rest, how it can create all these boom and bust cycles. What I find really interesting is that a lot of people warned us about this many, many years ago. For example, Henry Ford said the goal of these financiers is world control by the creation of inextinguishable debt. Thomas Jefferson, one of our founding fathers, once said, if the American people allow private banks to control the issuance of their currency, they will, first by inflation, or creating money and lending it out, which is what I put in brackets to simplify things, they will first by inflation and then by deflation, which is asking for the money back and seizing people's property if they can't pay back. By doing that, the banks and corporations that will grow up around them will deprive the people of all their property until their children will wake up homeless on the continent their fathers conquered. Another thing I found really interesting was that there was a book called This Time is Different. And what that book proves through several research and data is that these booms and busts or these market crashes that we are all afraid of, it's been going on for centuries. It's nothing new. So let's look at what that book has to say through the book review on our website. So here's a Wall Street Journal article talking about the book This Time is Different. And it says, boom, bust, repeat. Financial meltdowns typically follow real estate bubbles, which may sound familiar after 2008, rising indebtedness, and gaping deficits. I'm going to fast forward to some of the really good parts. For example, here it says this lengthy historical study gives what they call a panoramic view of the unending cycle of boom and bust, showing how claims that this time is different are invariably proven wrong. And they've compiled an impressive database which covers 8 centuries of government debt defaults from around the world. So, as we can see, debt always has the role to play. And the only reason that so much debt can be created is because money can be created out of thin air. Then the article goes on to say that, but they offer frustratingly little economic theory to accompany their findings. There is nothing here on the role played by loose monetary policy, which in layman terms means creating money out of thin air and just lending it out like crazy. There's nothing here on the role played by loose monetary policy in fueling the speculative manias, although this subject has been addressed by earlier generations of economists, most notably the Austrian school, of which Ludwig von Mises and Hayek are the best known representatives. And of course, the Austrian theory of the business cycle is something that we have previously discussed. So this leads us to the discussion on psychology. As we have seen, all these booms and busts are nothing new. They've been going on for centuries and for usually for the same reasons, which is the creation of too much debt. So when the market crashes, what it really means is that this smoke and mirrors game of creating all this debt and then artificially making things look rosy, this game has ended. And so the stock market and the prices are back to the fair value or even lower. The reason why they went so high in the first place is because of all this debt that was created. Now that it has crashed down, it means that the stock market is back at a fair value or at a good price. So which means it's a good time to buy. Unfortunately, what happens because of human psychology is that when the market crashes, people tend to run away and sell off their investments and wait for things to recover. Which is why there's a saying that the stock market is the only market where people run away when things go on sale. So as we have seen, the stock market goes up and down. Sometimes it goes up, which is called a boom, and then there's a bust or a crash that happens, such as in 2008. This is sometimes referred to as a cycle. Nothing goes up forever, nothing goes down forever. Other investments, such as real estate or bonds or gold, also go up in cycles. They don't go up forever, don't go down forever. So, understanding and embracing the fact that nothing goes up forever, nothing goes down forever, if you understand that and embrace that fact, it is the key to overcoming the fear of investing. This has been going on for centuries, as we just saw. It's nothing new. Learning this helped me overcome my fear of investing, and I hope it does the same for you. The conclusion of what we have studied so far is that A, prices keep rising due to inflation, and hence savings keep losing their value. But on the other hand, the stock market can be volatile. It doesn't go up forever, right? There is always a crash that happens once in a while, as we saw in 2008, in 2001, and even previously in history. And these crashes can scare people away or cause them to lose money. So, what's the solution here? If you put your money in the bank, it's definitely going to lose its value. But if you invest at the wrong time and you get caught in a crash, you could lose money. The only solution that I can think of is to get educated and invest with a proven strategy, which is what we're going to learn next of how to do that.